chances are you like to get paid to do absolutely nothing, and you like to get paid on a monthly basis. By holding income ETFs, this becomes a reality in the form of dividend checks written to you every single month. However, there is one part that often gets overlooked in these ETFs, and that is actually the true secret to building wealth, and that would be capital appreciation. But I have found an ETF that provides not only monthly dividend income, but it also gives some great exposure to getting those great capital appreciation gains in the stock market over time. Today we will be talking about Global X's QYLG, that's G as in growth, and then I'll be putting it on my updated comparison tracker that shows similar funds such as QYLD, NUSI, and JEPI. I do make videos like this quite often, but they are very time consuming, so please consider hitting that like button and subscribing, as it really does help out the channel and motivate me to make more of these videos. QYLG follows a very similar strategy as its more popular brother, QYLD, in that it does a covered call strategy on the NASDAQ 100 by selling covered call options, but it only does it on 50% of the portfolio, as opposed to QYLD, which typically does 100% coverage. This means that there's potential to not only get income from the premiums of doing covered call strategies, but it also opens the door for some upside potential. The major flaw with many of these income ETFs is that they really stunt or limit the upside, but that is slightly more mitigated with QYLG. Remember that options trading is heavily impacted by implied volatility. Historically, the NASDAQ 100 has more volatility than the S&P 500. Therefore, the premiums would be higher on the NASDAQ index. A covered call is essentially a contract between a seller and a buyer agreeing to transfer 100 share increments of a stock at a predetermined price or higher at a predetermined day. So QYLG, they generate income by writing at the money calls 1 month out, but only on 50% of their securities. And best of all, this should allow for monthly dividend payments. However, since options are only being done on half the index, expect half the dividend yield compared to QYLD. So while QYLD pays a little more than around a 10% dividend yield, QYLG is a little bit over 5%. We've definitely been spoiled if we think a 5% yield is way too low these days. Now there's 3 real-life potential scenarios with income ETFs like QYLG. In a down market, QYLG would benefit from the premiums received, but the overall value of the fund equity holdings would also go down. In a flat market, we again get the money from selling the calls, and the price of the equities has actually not changed. A few people in the comments have told me that in flat markets, it is possible for premiums to start drying up, and this is theoretically true. I mean, look at a stock like Verizon that almost always stays at the same price, and look at how low its implied volatility is, and therefore its premiums are going to be a lot lower as well. Now in an up market or a bull market, half the fund's gains will be limited since the fund sold a call option at a predefined strike price. So there is going to be some benefit from the increase in the index value, but some of that upside potential is lost. And as always, we do get to collect the premiums from selling the call. Some investors will be disappointed to find that QYLG has only been around since September of 2020, so it doesn't have that consistent track record and reliability that we can count on with some of the other income ETFs. In the almost 1 year since the fund has been around, it has returned a very impressive 31%, which is still trailing the S&P 500's return of nearly 40% in that same time span. This is with dividends reinvested. This is actually even more impressive because QYLD in that same time span is only up 21%, nearly half that of the S&P 500. So really having that extra 50% not being stunted with calls is really showing here for QYLG. And that's actually the reason why QYLG is able to stack up closer to the market returns. It's still not enough to beat the S&P 500, but then again, the stock market has done exceptionally well in the past year as we have recovered from C19. Do not expect 40% gains to be the norm. When we look at their top 10 holdings, of course it's going to be very tech heavy as it does track the NASDAQ. So you got exposure to Apple, Microsoft, Facebook, Google, PayPal, Adobe. The sector breakdown is about 50% tech with communications and consumer discretionary making up about 20% each. The expense ratio for QYLG is 60 basis points, which is in line with other global ETFs So that means for every $10,000 invested, that's $60 in fees that goes right off the top every year. Now that is quite expensive, but of course it's not only very time consuming to write your own covered calls, but it also requires a lot of money. $30 gets you exposure to QYLG, the covered calls, and the passiveness feature of this ETF, so sometimes it is worth paying up. Now before we put this on the comparison tracker, I know everyone and their grandma is going to be asking how this is taxed. According to their prospectus, which goes into much more detail of the fund, and every investor should look at this before making investing decisions, distributions are going to be taxed as ordinary income, unless they're in an IRA or other tax-advantaged accounts. So no surprise there, as it also follows how other income ETFs are taxed. I assume it's going to be a lot of ROC or return of capital. It's not going to get that preferential dividend tax rate as regular stocks. Alright, let's wrap this up by putting QYLG on the comparison tracker next to its brothers RYLD, QYLD, XYLD, and cousins JEPI, NUSI, and DIVO. Now all the information here has been updated, so QYLG is by far the youngest fund here, coming into the world in September of 2020. It has among the lowest yields on this list at just 5%, but what this list does not show is the capital appreciation, and if it was featured on here, QYLG would likely be among the top leaders. QYLG, because it is newer, it has just under $24 million in assets under management, which is by far the lowest on this list. But I have a feeling that number will go up with all the free exposure this video will give them. As mentioned, they do have an expense ratio of 60 basis points, which is certainly not cheap. Now they do have a little bit of a different strategy here than the other income ETFs, as they do covered calls on the NASDAQ 100, but only on 50% of the portfolio, so that allows for a chance at capital appreciation. I also want to note that there is no downside protection, so if the stock market falls, QYLG is coming down with it. So what's my overall take on QYLG? I think it's actually a very good midway point between those who are actually in retirement or near retirement to those that are still around 15 plus years out. Yes, QYLG in the long term will probably continue to trail the market. It's not designed to beat the market by any means, but with half the portfolio in position to track the gains of the NASDAQ 100 and the other 50% giving us a high yield, this could be a very useful ETF for a younger investor's portfolio. Now I want to hear what you have to say about QYLG in the comments below. If you have any video requests, make sure to let me know, and I might just make a video about it. These videos do take a lot of time for me to research and edit. All I ask is you hit that like button and subscribe. My videos are also found in podcast form under the Collect Cash podcast name. And as always, don't forget to buy, stash, and collect cash.